The reality is, I've said for eons that we're going to have a future of two-income, white-collar households that are renters for their entire lives.
All right, welcome to The Landscape. This is George Smith Partners monthly podcast. I'm joined by my co-host, Mr. David Pascale.
Hello, everyone.
And today we have a very special guest. This is Professor Eric Sussman of the UCLA Anderson Graduate School of Management, my alma mater. I took 2 classes, I believe, from Eric, if I recall correctly. And I aced both of them.
Yeah, it's funny. You say you aced. I was going to say barely passed, but, let's not worry about the little details.
All right.
We're here. You graduated.
Eric writes a quarterly newsletter. I highly recommend subscribing to it. We'll link to it in the show notes so you guys can grab it. But Eric, why don't you tell us a little bit about yourself and about your firm and some of the stuff that you're doing?
Sure. We have an hour, right? So let me get going. What's that old joke? Is enough about me talking about you? Would you please now talk about me?
Exactly.
But anyways, thanks for having me, gents. I'm grateful to be here. In fact, I'm grateful to be anywhere generally. But as Evan said, I've been a faculty member at UCLA's School of Management. This is my 30th year. To my knowledge, I'm the only professor in the country in both accounting and real estate. I actually joined the faculty as an accounting prof and morphed into real estate. Oh my gosh, and was it 96? So I've been teaching there. And Evan's, I would say this to any alum that I'm talking to, Evan, you were my very best student of the 5,000 that I've had, just for the record. But outside of campus, I'm the managing partner of Clear Capital. We're private equity shop, value add, multifamily, sort of in 7 states now. Obviously, we'll talk quite a bit about that. We've got about 4,500 units under management, maybe. I would say it used to be 2 billion of AUM, but given current valuations, that's down some. Maybe $1.5 billion. I don't know. We certainly will talk about that as well. And then I do a lot of writing. I mean, as you mentioned, my newsletter. I don't publish in journals that 5 people read out there. I write for everybody. I always write so that my mother can understand it, my 87-year-old mother, and she actually always reads my newsletter with a few questions, so I write for my mom. But in any event, I'm grateful to be here and lots and lots to talk about. Needless to say, my gosh.
Well, let's dive right in. David, do you want to kick us off here?
Yeah, I mean, I can't recommend the newsletter enough. Clear Capital LLC, Upside of Real Estate. I like the fact that you quote the Grateful Dead right off the top here. That's always a pleasure to read. So I'll jump right in. You talk a little bit about we had a lot of expectations with the Fed recently. We had the big cut in September with more cuts to follow, as we all know from reading my column and other columns. And then all of a sudden, the future cuts are becoming less likely or less of them. And there's a little bit of a no landing scenario where maybe inflation reignites. So what's been going on in these last few employment reports and in the recent jump in treasuries? Let's get to the question that all my clients are asking.
Yeah, I mean, look, I think you framed it really well, David. Look, we all knew a rate cut was coming in September. That was sort of no surprise to nobody. The only question we were all debating, or we're thinking, was it going to be 25 bips to 50 bips? And look, everyone that I know, and I certainly probably like you two, talk to a ton of people on a regular basis. It was 25, 25, 25. And then suddenly it seemed like it sort of shifted to 50. And then before we knew it, it was 50. But I got to tell you,
and that was when the Wall Street Journal reported it during the so-called quiet period.
Yeah,
which was an obvious leak. Yeah,
this sort of shift. But here, if you sort of step back, it's a very strange sort of concept to think the Fed is cutting rates and this is what I talked about in the newsletter, at a time when the equity markets are at all-time high, and putting aside even the eye-popping or so that blowout jobs report from a couple Fridays ago, the fact is even before that, unemployment was at 4.2%. Now, while yes, there had been some downward revisions and the job numbers maybe weren't lighting the world on fire, it certainly wasn't recessionary. You got
Right.
GDP numbers that were pretty, that are decent. I mean, I think what do the economists call our economy, despite the political rhetoric, literally this week, the envy of the entire world. Now, if I just told you those data points, you wouldn't go, "Oh, we got to cut rates. We're really in a world of hurt. We better cut rates and liquidity." So it's already kind of a strange time to sort of be talking about cutting rates. All right. So now what's happened since then, of course, we had, stronger than expected job numbers. Obviously, the treasuries have bolted from 360 to 420 in in a nanosecond, which is unbelievable. And so now the question is, what does the Fed do from here? If you look at the Fed futures curve, they've shifted their views, right? And I sort of have those data points in the newsletter. So now it's what's going to happen next month. Is the Fed going to pause? Or they get 25 bips? Who knows? And then one last thing I'll throw in here, I know we're going to talk about it, is look, we're running ridiculous deficits. We've got, our debt levels now exceeding, 35 trillion. And while we're sitting here shooting the bull, it's going up like, like nobody's business every
nanosecond.
Yeah, every freaking nanosecond. And so the question then becomes, all right, well, you don't have to be a CPA, an MBA, or even Evan Kinne to know that, look, when you start increasing the supply of bonds, right, of anything for that matter, right? This is econ 100, forget 101.
Right.
When you increase the supply of something, prices drop. In this case, bonds yields are going to go up. And there's a lot of other factors. You got to shut me up because I'll keep going like the the Energizer Bunny. But anyways, that's a starting point to sort of chew on some thoughts.
Right. And yeah, there's no doubt that it is weird to be demanding cuts when when the economy is going so well. And it gets into an interesting conversation where we talk about our sponsors and brokers saying, when are rates going back down? And meaning going back to the great lost decade of ZIRP, 2010 to 2020, and then a little on the pandemic, which was ultra low rates, negative rates in some instances. Maybe it's not going back there. So that's just another issue. What do you think of what's going on supply? And we'll just touch on this really quickly. In France right now, we're seeing they have done a lot of spending during COVID, trying to stabilize. They've had a lot of issues with the war in Russia and God, it's Zelensky, excuse me. What's the country? Sorry about that. Ukraine, right. So they've had a lot of, France, I'll go back. France has had a lot of issues with the COVID, with the Ukraine war, and they have done a lot of quantitative easing and goosing the economy. And now the rating agencies are starting to come down on them because they are over 100% of GDP with their deficit. The US, by the way, is at 99%. They do not have the luxury of being a reserve currency. And so they are dealing with some fiscal issues right now, and it could be an advance warning to the United States. What are your thoughts on that?
Well, again, a lot to chew on. Look, I won't necessarily just pick on France, although you're right, David. Moody's just announced, I think it was yesterday today, that they're going to be reviewing their ratings for a downgrade. Look, remember, the U.S. had a downgrade. I mean, memories are short. I'm trying to remember now, was it 10 years ago? I mean, but let's be clear. The entire EU, UK included, I mean, Germany is in a world of hurt. So they are all struggling mightily as a result of, even stepping back from, obviously the Ukrainian the war there. But even just following Brexit, and I think other structural challenges. So look, I don't think France is immune, although yes, they're maybe uniquely having some unique challenges. If we sort of think of the US, look, I'm not concerned about Moody's downgrading the US. I mean, even at our debt levels to GDP are nowhere at Japan levels, or even frankly China levels, where China, if you look at their entire public debt, we're much more serious. The, the US dollar is still a sovereign currency. We're not Bitcoin based yet, although who knows, with World Liberty Financial, got to buy into that. But so I'm not worried about the U.S. Reserve, losing its fiat status. I wrote about that, David, years ago. People were talking about the RMB, that China was going to take over the U.S., and I was like, you're nuts. That's just no way. That's just not happening, if nothing else, because of just the fiscal and currency, the capital constraints that China has. You can't have a fiat currency and have that kind of constraints on moving.
But what about China colluding with all of the rest of the BRICS nations to push back?
I don't. Look, and that's probably maybe a little over my pay scale on some geopolitical alliances. But look, is this honor among thieves? I don't buy that. I mean, this is you're telling me that you're going to have what Modi and Putin. I mean, look, well, Modi's.
I mean, they're doing it. I mean,
right. Well, they're buying oil. I mean, okay, let's be clear. So they're sort of circumventing the sanctions by buying Russian oil. Okay.
Right.
And North Korea is sending troops to Ukraine. I understand. All right, look, I mean, there's certainly some alliances going on, and frankly, not that we're getting all political here, maybe we will. I mean, we'll see if Trump does win, that will be very interesting. Frankly, a lot of our discussion here may depend on whether Trump wins, because he's certainly going to, given his feelings towards political leaders, we'll see. But Evan, I still don't think that moves the needle. I'm not worried about that impact on the U.S. ultimately. We're still the strongest economy in the world. It's not even close. As I said, we're the envy of everybody else. We have our problems, most of it politically, exaggerated perhaps in this election year. But like,
so why don't we move off of like the macro scale, and let's talk about let's get a little narrower then, and let's talk about the housing market. You spent a lot of time on housing in this presentation this time around,
and about affordability and age of buying and how it affects multifamily also.
All right, well, that's a huge topic, and probably the topic on which I speak and write the most, right? It's certainly of great interest to my audience, whether it's Clear Capital or my students, frankly. So look, we can talk hours on that. And I don't think there's anything novel, or I'm going to tell you things you don't already know, but obviously, look, housing affordability has never been a greater issue in the United States. If you look at it's never been more unaffordable ever in our history. So look, we're creating more renter households than ever. I've said for years, Evan, I've said when you were a student and years before that the future of the United States was higher density multifamily housing. That this whole concept of the American dream, and God knows we need to have a 3-bedroom, 2-bathroom, 3,500 square foot house. There's a 3-car garage because we need room for the Harley or the boat. Was completely impractical. Really a manifestation of our post-World War II and the unique nature of how our economy sort of developed after the war, with the highways moving west of the Mississippi. I mean, the United States before World War II was really almost all the action was east of the Mississippi. And since World War II, of course, California, imagine, is now the 4th largest economy in the entire world. So, I mean, what happened was we just developed bad policy, and now we're stuck. The reality is, I've said for eons that we're going to have a future of 2-income white-collar households that are renters for their entire lives, which is something that's never happened in the United States history. But it's sort of the fact that the United States is going the way like most developed, if not all developed countries in history, that we just, we're slowing down. Our population growth is at risk of actually turning negative in decades that are coming.
Household creation is down.
Yada, yada. Young people aren't look, and I talk a lot about demography. I mean, so go on. So look, the future of the United States is higher density multifamily housing, whether we like it or we don't.
Well, you're talking your book too. I mean, you could get a little pushback here on that. I mean, whether you're saying whether you like it or not, it benefits, you know, maybe the folks on this call disproportionately, you know, as investors or participants in that market. But, you know, from a political standpoint, you know, it's a huge issue. Obviously, affordability is a huge issue. Obviously, this is not an easy thing to answer, but let me ask you a bullet question here on this topic. Would you buy public home builder stocks today?
No.
You would not.
No. So you think about total, look, yeah, the short answer is no. They're if you look at their sales, okay, generally speaking, you're talking about you know, KBH, you know, Kaufman Broad, Toll Brothers, for example, you know, they've sold out entire developments to the, you know, buy to rent. You know, this whole BTR.
Yeah,
So
we've been extremely active in BTR, and I can tell you, like, anecdotally from our perspective, that has basically stopped over the last 12 months, and it's been far more like, yeah, there's not really a lot of what we call CFO deals, which are selling out entire communities to BTR developers or owners. That has slowed dramatically, at least in our business, on new starts. Now, will it come back in a meaningful way? I think absolutely. But right now, it seems like they can generate a higher price selling to the end consumer.
Yeah, but Evan, you say I'm talking. This is where I'm going to push back on you, because look,
you talking push back. We're having a chat.
No, but no, you said, you know, you sort of said I'm talking my book. The fact of the matter is that you're kind of conflating cause and effect. The reason I sort of started Clear Capital, you know, all those years ago, was because I saw the future of our housing. That's what sort of caused it. I don't think what I'm saying is even up for debate. You've got a median home price of $425. You've got shy of 9% of homes in the United States that are $1 million or more, as I cite in the newsletter. People just can't afford it. Look, let's just do some simple math. You get a conventional Fannie or Freddie first on a 425 loan. You need minimum $100,000 of liquid assets in the bank, plus. And, you know, you got to pay now. We're on the 30-year mortgages, and I haven't seen the Freddie data this week, but I'm guessing we're
mortgage rates hit an all-time, sorry, a 4-month high today.
Yeah, right.
I mean, we're back up to where we were.
Right, 6 3/4 probably. Yeah. You know, so look, I mean, people can't afford it. I mean, and look at the volumes, look at the data. You don't have to trust me. Look at the NAR data from, you know, of course, we're lagging. I think this, so we all have the August data. September data will be coming out this week, tomorrow or maybe early next week, and you'll see volumes are way down, and they're going to be down. I just don't see it. The fact is, people can't afford it. And look, let's be clear too, guys. There's a couple things to keep in mind here that are super important. One is the job market. As the job market goes, that impacts housing policy, of course. And I've talked about this for decades. Look, maybe not Evan, because you're the young whippersnapper on this particular call, but David and I maybe can talk about this. But like our parents' generation, all right, the greatest generation. So many of those folks worked for one company, 30, 40 years. And then you worked till you retired and got your pension and all that. Well, stop and think how much better from a home owning standpoint and for neighborhoods that sort of job stability sort of creates, right? Whereas now, let's say you, Evan, and your classmates, I will guarantee you that if you surveyed your classmates, and you've been out of Anderson for what, 6 years now, 5 years?
Almost 10 years.
Oh, there you go. Okay. So let's say 10 years. I will guarantee you that your classmates on average probably have already changed jobs 2 or 3 times.
Oh, yeah.
And we'll change jobs. Now, stop and think. How good is that for buying a house where you know, you're in a neighborhood in a certain area, and gee, I got a new job now. Shit, I got to commute another 10, 15, 20 miles. I got to figure that out. So that's one thing. The other thing to keep in mind, and I brought this up in class last night, and I can go off on my thing, is that if you stop and think about cause and effect, one of my former students raised a great point, is if you can't afford a house and you're therefore compelled to rent, and let's say you're in a partnership relationship, in a traditional, you know, marriage, whatever, your options for housing are basically a 2-bedroom apartment, 2-bedroom, 2-bath somewhere. Are you going to have 2 kids if you're in a double income marriage or partnership, and renting a 2-bedroom apartment, even a Class A amenitized beauty in Austin? Are you going to have 2 kids in that little place? No way. You're like, okay, no way. You don't have enough room. I would want you all to think about if people can't afford a housing, if we believe in that sort of preface, then is the fact that we are now an apartment housed nation going forward, does that mean by definition, actually, it's going to cause smaller families?
Yeah, interesting. So
Yeah.
you're looking at the economic inputs as well as the cultural inputs that are leading to
Yes,
our
I talk
sort of
about that. It's cultural
decline
and
of birth rate.
financial. It's both. There's
Yeah.
two things moving in parallel here for sure.
Right. So obviously a declining birth rate is, a big challenge for many economies. Fortunately, we have a lot of in-migration into the United States, which helps us out.
Well,
So,
not now, Evan. That's your issue. Well, maybe illegal and border crime. We got to get that figured out because we're
well,
not.
I think most Americans are not like opposed to immigration. They just want legal immigration. I think that's sort of a
Right.
I
like,
agree.
I don't think that the Democrats or Republicans really disagree on that. But
I won't argue with
maybe,
you there either.
what's that?
I won't argue with you there either. But it's political football.
You do a lot.
It's a political,
Once
yeah,
they
it's a hot
pass
potato,
legislation, they take it out of the political arena for. Look, that's a lot of stuff. Look at it's not that I can't. I don't get off on a tangent, but abortion.
Yeah, I mean, clearly, like, part of a functioning economy is at least a minimum a stable population base, right? And better yet, slightly growing. So, but back onto this topic, I want to just ask you a couple more questions in and around this. So you were just talking about couples, dual income couples, and their inability maybe to afford a house, which would allow them to have kids. Back to the build to rent topic, you were kind of decrying that earlier. I think you were pushing back on me on that.
I'm not decrying it. I'm just saying that look, that's what they've been.
But then you're a renter by choice, right? You're making a choice potentially to live in a home with 3 bedrooms, maybe 4 bedrooms, and a yard and whatnot, where it's a little easier to raise a kid. So just want to throw that back at you a little bit there. So,
well, in terms of what though, and what's the question?
Well, yeah, I don't know. Maybe you're pushing back against the whole notion that of sort of this build to rent market that's been established over the last 5 or 6 years. And granted, it has definitely slowed over the last year, just because homes have been, the prices that folks are willing to pay to buy a home exceeded that which an institution would pay, just because interest rates have been high, and maybe institutions have shown themselves to be a little more sensitive to that because they're underwritten like any transaction, right? So yields matter. I'm just pointing something out. I'm not trying to ask.
Yeah, I mean, look, Evan, the BTR, whether it's buy or build to rent, really came after the great financial crisis, right? After the GFC, right. That's when you had the roof stocks, the innovative homes, and their brethren.
Yep.
Came in, and we all agree they proved that to be a viable asset class. It was unclear whether you could scale it and do it, and they have. And it makes sense to me. I don't have a problem. I think people would say, oh, it's bad for neighborhoods and we shouldn't allow that institutions to buy homes. I'm like, why? If you allow someone who can enter a neighborhood just as a renter that would otherwise be unable to afford the unit.
Yeah, some people rent by choice. That's what I'm trying to say. Like,
yeah,
you can have a large, Lennar might have a large community and it's got 200 homes here in a pod and 200 homes here there for rent. Some people that could afford choose to rent because exactly what you said, people are motile in their jobs. They want to move every 3 years.
Right.
And like the friction of moving when you have to sell a home and pay, I know you talked about the NAR and the big lawsuit and all that. Like, this is still the friction cost of selling a home or buying a home is significant.
I agree. I no disagreement whatsoever. I think, as I said, so my point being that maybe I reword it, is that we are a renter nation. So the American dream is now rent, whether it's a detached single family unit that's a BTR or
sure.
or
an apartment. All right, well, let's get on to some other topics here. David, I don't know if you want to try to switch directions or if you want me to here, but
let me just, I would like to bring something up. Let's see, hold on.
Well, I got
you can bring something up, yeah.
Everything's fair game. Hey, I'll talk about
I'm locked and loaded, baby.
Dodgers, Yankees. You want to talk about, I don't know,
No, no.
Yeah, school. What's going on at UCLA's campus? And was I part of the encampment? I mean, we can talk about
Yeah, I
anything.
want to know, were you living in there? I mean, did they?
Hey, that's part of my free housing. That's right. We have
Exactly. It's
encampment.
part of
You
your
know,
thesis, right? It's like, hey, what can I get?
Right.
All right. Let's talk about apartment deliveries. Okay. Obviously, we're kind of in this weird trend, or this weird market where it's very difficult to finance ground up construction of multifamily. So, I think Clear Capital has traditionally been a buyer, not necessarily a developer of real estate, right? So how do you see the kind of slowing supply and mini markets just due to the financial markets making it more difficult to capitalize new deliveries? So that means, capitalize new starts. So we should, it'll be interesting to see what happens in 25, 26, right? With the slowing of starts for multifamily apartments in, let's see, 24 and 23, right? Just, do you have any thoughts on that?
of course. I mean, look, and there's a ton of different data sources, as to how many units are actually being delivered, depending on where you get your data.
Right.
But again, you don't need me to tell you that it's common sense, right? That
Mhm.
new projects don't pencil. Look, if you think about, of course, the cost of financing, but even just things like, of course, availability of lots, cost of construction,
Mhm.
availability of GCs and subs, and good old NIMBYism, and it's just difficult to build.
Regulation,
Every,
entitlement, the
and it's hard.
cost of entitlement, the
And
drag of that.
it's on the margins. See, when you go into a new community, people realize where so much housing units was added in the last 25 years, was a lot of it in the urban cores for a while, because again, there was no one to object. We had the white flight of the 60s, 70s, and then 80s. And then suddenly we're like in the 90s, so we need housing. Where can we build? Well, downtowns are wide open, and there aren't people
Yeah.
to object. In fact, people are welcoming people to build downtown. Okay, now that trend has sort of been, dealt with. And so now we're talking, where can we build? You're talking, multifamily projects in certain, at least adjacent to urban cores, where people are young people want to live and work, right? So there's no question that the deliveries are going to come down substantially, and whether that's in end of 25 or into 26, and that will be welcome news to the multifamily market, because of course in our Sunbelt states and Austin and Phoenix and others, it's been obviously challenging on the rental side. Um, but we need a population growth too. This is where again it's not just about the slowdown in starts and new deliveries. It's also, we need people that will rent them. So that's where, again, whether it's our declining child rate, birth rate, or immigration and so forth, our population's stagnating, and so that will also be relevant to future growth in apartments.
Okay.
I'd like to add something on that. Our whole business has been almost upended by the rush to the smile states, the developments, and we know the places, Florida, Phoenix, Dallas, Tennessee, etc. And you bring up a great point in your newsletter. You go, what about Buffalo, Lincoln, Kansas City, and Milwaukee? These, we never hear about them. There's no institutional capital going there. There's no cool finance bros doing Wall Street Journal articles about buying Class B and C apartments. And we have a client that's buying a lot in Ohio,
Yeah.
and these markets are, in the recent years, are hitting some eye-popping returns. And does that mean that those markets will get, the institutions are going to come at them and overbuild there, or are they just kind of B minus markets? What are your thoughts on them?
Yeah, that's you're absolutely right. I kind of, it's very rare when you use the words buffalo and hot in the same sentence. But
Right, right.
unless you're talking about the Bills or something on a
The Josh Allen,
Josh
latest
Allen,
steps.
yeah, and Stephon,
Yeah,
but what I would say is, look, I don't think necessarily going to see Avalon Bay or Goldman
right.
sort of entering Milwaukee anytime soon. But that's who we should all be talking to. So what is Avalon Bay, Essex,
Right.
and Capital Partners sort of thinking about those markets? Look, that's a per example where you had kind of two factors. One is again, the supply. Nobody was building, nobody was adding
Right.
significant inventory to
And jobs are showing
Columbus
up,
and
you point out.
yeah, in Indianapolis. And then you had, look, jobs, because I know everything's so political now and no one wants
Yeah.
to acknowledge anything. But look, the fact is, it brought some inflation, some of this legislation, but it did bring some manufacturing jobs back to the Midwest. And in fact, it's part of the issue why Springfield, Ohio, which no one would be talking about unless you're talking about The Simpsons.
The Simpsons, yeah.
Is because those immigrants,
Because
to help them fill jobs. They had manufacturing jobs that are needed. If you actually interviewed the business owners of these companies, said, yeah, we need people to fill these jobs in manufacturing. So that's what's happening in those states. But look, David, I don't see a huge supply coming soon to those states because
Kansas City, though, David, we've seen a lot of deals
Kansas
there.
City,
In our firm, we've got a half a dozen nice deals in Kansas City, and I think institutional capital is starting to come in there. Some of these Midwest cities, people forget, like we live on the coast here in LA, and then of course we work with a lot of capital in New York. And it is true though that some of these markets are proving to be very stable. Indianapolis, for example, very stable market and has done very well. Whereas some of the Smile states, got a little too cool to do deals there,
right?
And too many deals got done. And, we'll see how long it takes to absorb and to get the rents kind of trending the right direction. But it's yeah. So I don't know. I think we could see some institutional capital trickling. These guys are lemmings, right? So once one or two of the big guys gets in, and then
yeah.
Well, that's what I said. So talk to talk to the Avalon Bay folks. I mean, they're probably as good a proxy for Class A amenitized construction as I can think of, and I have a lot of respect for those folks.
So on the
when they're going to Detroit, Columbus, Indianapolis, Buffalo, then mark your calendars.
Right.
All right. So Johnny Cash going on tour. I've been everywhere. Right? No, I'm kidding.
The great song.
Yeah. All right. Let's stay on the real estate market dynamics thing. Let's move over to like this challenge that we have, the wall of maturities. And of course, David and I have been talking about this nonstop forever, but the can keeps getting kicked, and it seems like we're out of kicking maybe. So any thoughts there?
We just saw sorry to interrupt. We just saw an S&P report talking about loan extensions. And what was interesting is they're all not principal pay downs. They're all extensions of payments or forbearance. And it was all because rates were coming down, meaning fixed rates were going back down. And now here we are almost at the end of 2024 and into 2025 with all these maturities kicked. Rates aren't down yet. What's going to give? And it's interesting that multifamily is up there with office in dangerous loans.
Yeah, I talked about that in the newsletter as well.
You do.
It's a good thing that I have a Kirkland bottle of Tums on my desk.
We know you like Costco.
Do I like Costco? Evan, how dare you understate my relationship?
Your love for Costco. I know I have two kids, so I am a firm believer in Costco.
Yeah, I mean, I said I'm glad they sell the antacid in institutional size bottles.
Right.
Look, that is the gazillion-dollar question here as you have maturities, and I think part of it is sort of depends, right? Who's the lender? And this is just anecdotal. I've heard that now the money center banks and the banks themselves are now just foreclosing, or they're not maybe being as lenient on mods and extensions. The extend and pretend, or what is you remember Gary Mother used to say, what a rolling loan
gathers
losses or
no
losses.
Yeah.
I do think what's going to be interesting is what are the Luments, the Starwoods, the Cerberuses, sort of these funds, what are they going to be doing per se? I think part of it is that, look, I mean, they did all this floating rate short-term product, which is now coming due in 26, a ton in 26 and 25.
Mhm.
I think part of it is sort of depends on a few things. One is their bandwidth, right? So if they're going to foreclose and, because part of it is liquidity in the market is still not great. So if they're going to take the keys and then try to sell, and of course, in most cases, I think their debt is protected. But they may be thinking, think of it, put yourself in their shoes. Right now, they're probably earning yields of 9%, 8%. I don't know what, let's say, some of these funds are generating in terms of yields where there's interest rate caps. So they may be thinking, look, as long as they can afford the cap and keep our yields going, our debt is safe. So, in a certain sense, actually, I think it's in their interest, believe it or not, as long as they're still maintaining the yield, they're not in default on their CLOs or their
Mhm.
lines, warehouse lines, to sort of kick. And then at the last minute, they can always foreclose and sell and get their debt balance back. But think about for them on the reinvestment. That's what they do. That they take title and they monetize.
Mhm.
They get their, then they have to reinvest or pay back off their warehouse lines,
Right.
investors, and they don't get nearly that same yield that they got. So I actually think it makes some sense for them, if as long as the operators with whom they're dealing, their borrowers, are experienced and aren't, are good operators. I think it's actually not illogical for them to sort of extend, but
I
as
agree.
long as they can keep their yields. If they can't, well, then
Mhm.
the decision becomes easier. We'll just, take back the property.
I have another question, and it gets a little bit to macroeconomics and what we're talking about with the Fed and when they're going to cut, and was there a fear when they cut 50 bips? Did they see something breaking in the employment picture or not? And then the question is, the consumer keeps on consuming, and that's what is the bottom line of what's keeping you. When you look at the jobs market, where I can't talk enough about leisure and hospitality. It's undefeated. It can't be touched. So you have leisure and hospitality, travel, etc. Health, we do have some healthcare and government kind of leading the way. And do we have a two-tiered economy where we have the haves and the have-nots? We have the K-shaped recovery where you have these, the haves taking all their stock market winnings from Nvidia and Apple, et cetera, and spending them. And then we have the other side where we're seeing credit card delinquencies and the paycheck to paycheck. And are they going to start collapsing, and the top keeps going? I mean, where are we going? What's the next year look like?
David,
You
you
sum it up
threw a
for
ton
me.
at me there. You threw the Fed, the balance sheet, the deficit, the consumer.
I
I
know.
might, so we have to let's sort of break that into pieces because there's a lot to
Sorry.
unpack there, right? I think let's look. We already talked a little bit about our budget deficits and our debt. So let's talk a few points. So let's talk just the realities of the Fed. Let's just start there really quickly, if I can. You got 35 plus trillion of outstanding debt right now. We're spending more on interest on that debt than we do on defense spending and healthcare combined, right? It's just unbelievable. It's unbelievable. So to a certain extent, with 35 plus trillion of debt, a $2 trillion annual deficit, and the Chinese sods and the Japanese not buying our bonds the way they used to, we have to cut rates somehow. I mean, I just see our because our debt service,
they have to.
You mean cut spending?
Our debt service is so extensive. But on the other
No,
hand,
they mean cut rates to cut the debt service.
right. So that's one pressure point.
Yeah, but why would someone buy a new bond with a
Guys, you gotta let me finish. You asked me the question, so you gotta let me finish. So let me finish my thoughts, for God's sake. You interrupted my mother-in-law. Look, but on the other hand, I was going to say is if we're not able to compel the Japanese, the Chinese, and the Saudis to buy bonds, how are you going to compel them with lowering rates? Usually that means you must be with supply. That's what we said earlier. So there's two competing forces there. One, our need to cut rates so we can service the gosh darn debt, and yet increase rates so that we can compel those to buy our bonds. That's the two forces. All right, that's that. On the consumer, look, What you said is exactly right. I've always said we have the haves and the have-nots. The haves are fine. Who owns most of the equities? It's the rich. Who owns the assets?
Right.
The rich, and they're fine. I don't know of anyone in my peer group who's saying, "Gee, I don't know about going to Maui or you know, wherever this year because gosh, we're just really hurting." No. But then you have on the other end of the spectrum, wealth inequality has never been greater. If you look at something called the
Yes.
Gini coefficient, I talk about this thing called, I never heard of this. I just read it, something about ALICE, asset limited, income constrained, employed people, and who don't have a pot to piss in, forgive my French, but you know, $100 of savings. Yeah, they're when the cost of eggs or bread goes up, they feel it. This is the thing that's classic is how many of these people get on it for political and say, oh my God, inflation is just horrible, the cost of groceries. And these are rich people. Give me an effing break. They're not hurting. Yeah, when I go to the store, I don't like paying as much for eggs, or but I pay it. I don't, it doesn't even affect. And the same with the two of us on this call. But for so many folks out there, it's a real issue. And so that's the problem. Now, one last thing is I said in the newsletter, I'll say is, look, you want to see about the economy, you got to look at discretionary spending is what I talk about. So I actually coined, unfortunately, I can't get the data, but something called the SSBI, the Sussman Spa Booking Index. If I could get a data on the how appointments are running at Burke Williams or certain spas out there, that's how the consumer is doing. So look, you can get Vegas drop every month. They publish that. The Las Vegas Gaming Commission drops the Vegas spending every month, and you can sort of get a sense. And they're doing okay. There's still people spending travel, leisure. David, to your point, gaming, spas, facials, aromatherapy. They're spending. All right.
So let's wrap up here. I have a question for you. Try to make it dead simple. The Eric Sussman party is now fully in control of the House, the Senate, and the president.
God.
You're faced with all these challenges, the erosion of the middle class that we talked about, you know, the struggles with inflation, China and Japan aren't buying our debt, blah, blah, blah. What do you do?
Yeah, well, okay. Did you say that was a simple question, Evan? I mean,
no, I said it was a wrap-up question. I don't know. It's not.
Yeah, I mean, look, I mean, this is where let's cut to the big picture. Like, just a few points I make all the time. Policy is hard. Okay, you want to talk about issues of immigration, tax, healthcare, defense. You know, all these issues, they're challenging. Okay, and if I were in charge, first thing I would get is the smartest Democrats and the smartest Republicans on any issue into a room and let's hash this out, because I can guarantee, and the goal is to craft the optimal policy, not the frickin' perfect policy. It's Bentham philosophy. It's the greatest good for the greatest number. All right. But they don't want to do that. That's not the objective anymore. It's why I wouldn't come near politics as much as that would have been probably passionate. That's what I would have done with my life. But because I care about policy and not about politics. But Evan, look, you get the smartest people that sort of craft it, and you have to be willing to, when you make mistakes or there's unintended consequences, to fix it. It takes time, energy, discipline to do that. That's number one. That's on all these issues I would do. The second thing is, again, we do need to get our spending in check, cut our spending, and get our tax policy right. It's a joke. Yeah, we have such wealth inequality, and I'm not a fan of paying taxes, but we need to recalibrate our tax structure. We just do. And whether we can argue and have, again, on the Republicans and Democrats side, what's that, whether it's 400,000 or a million or 10 million or more, some threshold at which we tax more fairly. And then we, whether do an Andrew Yang thing or something to help out. Look, I'm a compassionate capitalist. That's what I am. All right. I believe in helping those who can't help themselves, and we should be doing that. And there will be fraud and all that. But I'm telling you, we have to do the greatest good for the greatest number in policy and get people into Congress who actually give a rat's ass about policy, and not whatever news media outlet is sticking a microphone in front of your face so you can get some comments for the 5 o'clock news hour, if it's even freaking news anymore. How's that?
It's just sound bites. All right. I think you dodged a bullet not going into politics, because you like to talk and you would have been sound bitten to death, buddy.
You know, I don't. But Evan, you also know I couldn't give a crap. That's why I said
I know.
I would say
you're
what
being
I think.
honest. I think the good thing is it's impossible today to be honest,
Right.
and that's the challenge that we have,
It is.
and that's why this election cycle is so,
Honesty is not rewarded.
no, it's not
No,
rewarded.
you're
That's
absolutely right.
exactly right.
It's very, it makes me sad because I like to think of myself as a very principled person, and I would just do what's the best for the most, as I said. But you know that everything gets twisted in this
Yeah.
soundbite social media world, and I can only do so much on TikTok.
There you go.
All right. So with that,
Okay.
where do people find out about your TikTok
Oh
or your
well, TikTok.
newsletter?
Yeah, well, look, you can connect with me on LinkedIn. That's easy for everybody, and I'm there. I'm the handsome Eric Sussman, not the winemaker, unfortunately. But clearcapllc.com if you want to get my quarterly newsletter. Look, you can check it out on LinkedIn, so you don't feel like you have to sign up for it. But if you want to sign up and get it in advance, you can sign up at Clear Capital. No obligation.
Well, we really
Okay.
appreciate having you on today. Again, this is the
Thank you very
Landscape
much.
Podcast with George Smith Partners. Thank you, Mr. David Pascale. You can find out about our newsletter. David writes every week, gspartners.com. Sign up for FinFacts. And you can find this podcast just about everywhere.